The We Company, parent company of WeWork, is the latest in a string of startup unicorns set to go public this year. Its core business revolves around leasing whole buildings or parts of buildings, transforming them into hip co-working spaces, and then renting them out to everyone from startups and freelancers to large enterprises. WeWork is now the single largest office tenant in New York, and SoftBank's valued it at $47 billion.
It was created just less than 10 years ago with the premise of creating a new way to work. So these are co-working spaces where people can rent a desk for a day, they can rent an office for a month, and the whole idea is that there's a community behind it as well. So you're not just buying desk or office space, but you're buying into this new way of working.
But just like other newly public companies such as Lyft and Uber, WeWork is not turning a profit. In fact, it's hemorrhaging cash.
Believe it or not, they lost more money last year than even Uber did. They burned through $1.9 billion in cash, and that was actually greater than the amount of money they brought in, their revenue.
The only difference is, for example, if no one called for an Uber tomorrow, Uber wouldn't have to pay all those drivers. But if no new tenants showed up at WeWork tomorrow, WeWork has, however many hundreds of buildings now that are ready for them. And so that occupancy would be an expense of WeWork.
Despite its losses, the company is growing quickly. Now, WeWork says it's in 485 locations and has 466,000 members, up from 186,000 at the end of 2017.
How fast are you growing?
Very.
What kind of numbers are we talking about?
We're talking about probably one of the fastest physical expansions that has been seen for the past 10 years.
Right, it's the sort of tech startup playbook, growth at all costs. And at least in the private markets, investors have been fairly receptive to this model. That's why WeWork, as well as Uber and Lyft, Pinterest, many others have been able to raise so much money. But what we're seeing right now as these companies go public is that public investors may have a different attitude towards this strategy. They may want to see a path to profitability, which so far WeWork doesn't really have.
Basically, Lyft and Uber's stumbles may bode poorly for WeWork's chances of a successful IPO, since all companies are currently focusing on growth over profits.
I think the market will be less receptive to that story today than it would have been a month ago. It's going to be very difficult for them if they don't have a very clear numbers-based narrative for how their loss profile is going to improve significantly.
Traditionally, WeWork has relied upon funding from private investors, the largest being SoftBank, which has poured more than $10 billion into the company, including $2 billion this year. But once WeWork goes public, its value may depend on whether investors view WeWork as a real estate company or a tech company.
Critics would say that it's just simply an overvalued real estate play. All it does is take out leases, longer-term leases, and then rent out these spaces in the shorter term, which could be a recipe for disaster if we ever were to see a recession.
We're not a real estate company. We're a community of creators, and what we do is we take space, and through dividing it up, through sharing it up, we give creators all around the world the opportunity to change the way they work.
But the We Company actually did recently set up its own real estate investment platform called ARC, so it can buy and develop properties around the world. The announcement came after Newman received criticism for buying buildings himself and leasing them to WeWork, potentially posing a conflict of interest that could be alleviated through ARC, since it will be run separately. ARC will still be under the We Company's umbrella, though, and Wallace cautions that with this new venture, the company is taking on even more risk.
It means that when things get bad or when things change, it's harder for them to be flexible. Because if you rent the building, at least theoretically, there's a cost that you can pay to get out of that lease. It's harder if you actually own the thing to get yourself out from under the costs associated with it.
The company has also expanded into housing and education over the last few years. One division, We Live, offers co-living spaces in New York and DC, basically flexible apartment rentals where residents share amenities and can stay for days or months. Another division, We Grow, recently opened a for-profit pre-K and elementary school in New York, billed as a place that fosters conscious entrepreneurialism for its students. The company has even expressed interest in branching out into banking. To better reflect all these various offerings, WeWork rebranded as the We Company at the beginning of the year. With all of this, WeWork is aiming to use its technology platform to capitalize on the idea of community more broadly, whether that's in the workplace, home, or school. So if investors do buy into this concept of WeWork as a diversified tech platform, its value proposition makes much more sense.
I think part of what gives them that tech company vibe is the network effect. And I think that in growing into other areas, such as WeLive or WeBank, simply helps them solidify that network effect, and that overall it'll help drive value and eventually profits for them.
Right now, though, WeWork's main business still is renting and leasing massive amounts of real estate in some of the most expensive cities in the world. It has 59 offices in New York, 47 in London, and 25 in the San Francisco Bay Area. While it competes with other co-working and office rental companies like Regus, Industrious, and Impact Hub, WeWork is the only one valued like a major tech company.
So this is the other thing about the sort of Jedi mind trick that WeWork has presented to investors that are giving it such a lofty valuation is, renting offices, isn't really rocket science, right? So the risk is that they build WeWorks in a huge number of buildings at phenomenal expense and don't have enough tenants. And so if you have the full load of costs of renting and building out all of these offices and furnishing, kegs of beer and new ping pong balls, and you don't have tenants, it's going to be very difficult for them to rationalize those costs.
If it's going to live up to this valuation, a key driver of profitability could be the growing number of WeWork enterprise members. That is, big corporations that have longer rental contracts than freelancers or startups.
40% of the business are long-term commitments,
Okay.
longer than a year. And then another 20% are longer than month to month.
The likes of IBM, even Amazon are renting office space from them. So the idea is in the future, you get a lot of this subscription revenue from the bigger companies, and that is enough to eventually bring in money.
For now, WeWork says its losses are not a problem.
Minson also urged me to look at losses as investments because he said that co-working is a proven business model. And guys, that may hint at the narrative the company will sell to Wall Street as it heads towards its IPO.
So why not just focus on growth now and go public later?
If you're losing $2 billion a year, then you have a very big cash problem that you need to figure out a solution to, and the public market, is obviously one place that can do that.
Basically, given the rate at which WeWork is spending, it may need more than what private investors can offer. While the company recently raised another $2 billion from SoftBank, this was actually a disappointment, given that SoftBank had been considering a $16 billion investment.
There are just very few private players that can write those kinds of checks that they need in order to grow at the pace they'd like to.
In this climate, though, WeWork may find it hard to get underwriters on board.
One of the choke points that we see is that there are only a few underwriters in the world that could lead manage a deal this big. And so that is one of the things that WeWork is going to have to overcome, is find a set of underwriters that are willing to tackle this, given the rough sledding that both Lyft and then Uber have seen.
But assuming WeWork does go public soon, it's already amassed so much power that some believe failure isn't even an option.
WeWork has now become one of the biggest corporate landlords, so some might argue that the company is now too big to fail, that the real estate developers which they rent from won't allow the company to fail because they have so much at stake.
Of course, WeWork's ultimate vision is far more ambitious than just being propped up by developers.
WeWork wants to become a platform. They don't want to just be co-working. They want to be in the education space, the living space, potentially even the banking space. The idea is sort of the Amazon playbook. You become so big, you invest so much into the business that one day you do turn a profit.